You always have to start with the math, which is if I'm going to try and sell a product online and I'm going to use Facebook ads, I can assume two things. One, EPCs will likely be around $2, potentially could be up to 5 as of like recently, depending on what category you're in. If you're like in health and wellness, you might see some like pretty high spikes. And then you kind of have a rough ballpark of conversion rate, 3 to 6, 7%. And you kind of just use those two metrics to determine like what your cost per acquisition is going to be. So in this example I just used,
The reason that founders ads work a lot of the time is because it's the founder talking about the problem that they solve for themselves. And it's like a meaningful thing. And like, it's really hard to make a founder ad that works if you just went on Alibaba and knocked something off. I'm sure there's plenty of dropshippers that are like printing money and they don't actually do anything novel, or they're stealing somebody else's IP, probably mine.
Taking on debt, it's just like anything else, right? When you do in your business, that if it's a short-term fix and there's not a plan of how that will be avoided, then it's a Band-Aid, and that's going to be something that you're going to lean on, and it's not a good thing. It's like you need a plan for how you aren't going to necessarily need this short-term stuff.
between the two of us and then hiring these kind of fractional CFOs, we were able to build something that was definitely more robust than what a brand at only $1 million in revenue had done. And I kind of knew that I needed to impress them to the point that I knew exactly what I was doing, which is why I was asking for more money maybe than a brand should at only $1 million in revenue.
And now, let's take a listen to the Scalability School podcast. Lots of good stuff that we've got going today, talking about using debt to grow on this episode. Super stoked to talk about it, as always. Very excited. Zach and Brad, what's going on, guys?
I think I say living the dream like every other episode. So
I was going to say,
just keep that going. The dream.
Let's just throw that in GPT and get a couple.
Let's put beefs at the front of the show and talk about Zach's tweet about the playbook that everybody needs to follow.
Yeah.
Who are we flaming today?
Hey, do you want me to read it back to you? Or you just want to rip?
I mean, we can just start by me just like seeing things on Twitter that are ex-Homestead clients that are just being obnoxious. And then that usually prompts me to fire off a, 10,000 character tweet at like 7 a.m. the second I wake up, which is what I did today. So yeah, I was just talking about the fundamentals of DTC, which I feel like are fairly straightforward and a lot of people talk about a lot. But that's what I tweeted about this morning.
You know, it's really interesting. I don't remember where I feel like this idea of founder ads keeps coming up and like people keep talking about it. And literally your first point in this tweet is like, here's the playbook, sell a product that solves a problem. And like the reason that founders ads work a lot of the time is because it's the founder talking about the problem that they solve for themselves. And it's like a meaningful thing. And like, it's really hard to make a founder ad that works if you just went on Alibaba and knocked something off. Those work. Don't get me wrong. I'm sure there's plenty of dropshippers that are like printing money and they don't actually do anything novel, or they're stealing somebody else's IP, probably mine. I don't know. I think a lot about that because it's been a recurring theme I've seen.
I just think that the easiest win that you have in this whole D2C e-com thing is just solving a problem and just like making it abundantly clear what problem you solve and how you've done that. If you're just trying to sell whatever, like if we were just a hollow socks, just selling cotton socks, what problem do I solve? I don't know. Like they look cool. Like it's just really hard to win in 2025 when you're just trying to be another one of 1,000, brands selling the same old shit. So that to me is like the fundamental start there. Boom, solve a problem, make sure the product solves a problem, make sure you can talk about solving the problem. And then I go through a bunch of stuff, which I mean, if we want to riff through this, we can. But this is basically me just coming off of seeing people complaining and basically saying that they deserve things to happen and performance to happen. And when nothing changes about their business and they don't listen to smart people who are giving them advice that's been proven time and time again.
Well, why don't we hit the highlights of this? Like, why don't we hit some of the pieces that people have engaged on that you feel like are the parts that people really wanted to get into? I mean, obviously, too many people don't know the numbers. That obviously goes into today's episode talking about using debt to grow.
Totally. Starting with the math of just like how you're going to like sell your product. You always have to start with the math, which is if I'm going to try and sell a product online and I'm going to use Facebook ads, I can assume two things. One, EPCs will likely be around $2, potentially could be up to 5 as of like recently, depending on what category you're in. If you're like in health and wellness, you might see some like pretty high spikes. And then you kind of have a rough ballpark of conversion rate, 3 to 6, 7%. And you kind of just use those two metrics to determine like what your cost per acquisition is going to be. So in this example I just used, your goal should be to have 100 plus AOV if you're selling a one-time purchase product, unless you're selling like subscription or a product that has like a high return customer rate. And on that, you can probably expect a $50 new customer CPA in 2025 with a $2 CPC and a 4% conversion rate. So that's how we back into all that math. And I'm like, you just have to start by understanding that, because there's so many brands that start or they're, a few $1 million in revenue and they're like, why can't I scale? Well, your math just doesn't work. You're selling a product or you're even selling a bundle of products and it's like $60. But like to get a CPA that would work for a $60 AOV is just like too hard to do. So starting with that math and understanding what's realistic there, I think is really important. The landed margin of like 60+% is so important. People do not think about that also. It's like, okay, I think about my cost of delivery. Maybe you're ordering product or not even cost of delivery. You're thinking about your COGS, cost of goods sold, and you're thinking about, oh, this is like what my product is going to cost from China, or I can order more and get my COGS down. What you're not taking into consideration is like your pick pack fees, your shipping to the customer, if you're shipping out of the country, if you're trying to scale to maybe like Canada or somewhere else, EU, Australia, what is that impact going to be? I think the other thing too is like people will do things on their website, turn products into bundles, but then not think about what their fulfillment team, their 3PL is going to now charge them to do a bundle because now there's more products included. All of that math is important to understand before you're like, hey, I have this thing that I think can work. So I think just starting there as a baseline of like 60% margin left over after that product or products have landed at your customer's door should be your target. And if you're not there, you probably need to charge more for your product or bundle more things to create a bigger piece of margin for you. I mean, the other stuff here I think that's really interesting is like keeping your product selection simple. We've seen this time and time again. Anyone that's run an agency has worked with a brand that has way too many SKUs and then they just like fall off because they just get buried with like so many dead SKUs, don't know what to do with. And that's where all their cash ends up sitting, is just in dead inventory. So that was one. What else here?
Can I ask about the margin thing really quick?
Yeah.
So maybe not ask, but just like dig into it a little bit deeper. But like thinking about when we had a whole offer episode, which I think is valuable to dig back into. But like quick TLDR, it's like if you aren't at that point, what are you doing first? Are you saying like, okay, great, I have 50% margin. Am I going and am I yelling at my supplier and trying to make it cheaper? Am I asking like what volume I need to get to those points? Okay, so that's one thing you could do. You can raise your prices, but like, are you going and looking at the market, or are you just saying, no, this is what I need in order for this to work, and I just have to figure out how to position it in a way that people will value it at this price? And then three, like on the point of shipping, I suppose you could always just like charge shipping and test that out, but what's your like order of operations working through that?
Yeah, it's initially starting with just like all of the moving pieces that goes into the cost before I even talk about like changing the price. Changing the price kind of comes last. So it's like negotiating with manufacturers, negotiating with 3PLs, negotiating with your FedEx or whoever you're shipping with. Like we just moved from US Postal Service, which was like traditionally the lowest cost of shipping for one of our brands, to Amazon. Like, this is a new thing that they rolled out, is like Amazon Prime shipping. They'll come to our warehouse, pick up big Amazon truck and pick up every order that used to be US Postal Service. We're saving like $1.50 per order delivered at the customer's door. Like that over volume can add up to be real dollars. So yeah, I mean, all of those things can be negotiated. That's like the thing I keep sending this like meme of like, just this random guy that just says like everything can be negotiated and just like keep putting it in Slack. Like it's in the partnerships channel and like whitelisting channel. It's in the like ops channel. It's in the product channel. It's in like everywhere. It's in any agency that we hire. I'm like, go negotiate. So I think if you're not doing those things, you got to be a little bit more of a hard ass and go do that first. Then it's pricing, right? Then it's kind of like seeing what's possible. Yeah, that's where I started. That's where I think you have to start. But there's so many little things that people are like, my 3PL charges $3 per order. That's what they say. Go ask them to do $250.
You're right.
Everything is negotiable. Like say, hey, this is where my volume's at now. If we can get it down to $250, I think I can get my volume to here, which means more dollars in your pocket at the end of the day. But if I'm stuck by losing 50 cents per order, that might just be the little bit of nugget that I need to go push a little bit harder.
Yeah, well, I think that's an important point, because like you're not trying to be a shit partner by asking for better.
Totally.
You're not trying to be a dick. You're just trying to get
Right.
better margins so you can run a business that will support their business, right?
And again, this will go into like the episode, but like building models of what could be if you get better margin across all of your partners is what's going to help at the end of the day. So that was a big one. And then like the offshore talent for building creative teams out. Like I think that we've learned a ton. Easy Street in our portfolio now of like, we're just going to hire creative strategists, designers, editors. This took me like years of Brad just absolutely hammering me and saying, you're an idiot. Like, why aren't you doing this? But finally it's set in this year. But now we have a team of like, what is it? Creative team members on each brand, between creative strategists, editors, designers. And that total cost is, we're talking maybe $25,000 a month to have 7 amazing, incredible people. Might not even be 25. So that was a big one that a lot of people ask questions about, was like, how do you go about doing that? How do you think about it? And my answer, which is like one that I normally hate, is go look at big creative agencies and go poach their people off of LinkedIn. Don't do that to Homestead, but like, if they're a big creative agency that has, 500 employees and a bunch of people in the Philippines or, Central America, that's a good starting point.
All super good tips, right? I mean, I think we're just talking about negotiating with influencers, right? So yeah, I agree. A lot can be negotiated. I think that's a huge point. And I think knowing the numbers is a good one. And per usual, you put something out on X, dude, the crowd absolutely loves it. Sitting at 10.5K views, not
That's actually
even
pretty
12
soft.
hours in.
Yeah, it's pretty soft. That
I
should
put
get
out a
up.
lot of stuff. Absolute freaking crickets from the Foxwell machine. Nobody cares at all. But
Yeah.
I did get a text yesterday from a guy I hadn't spoken to in a long time who was driving down the 405 in LA listening to our podcast in his Cybertruck. So shout out to you, listener. You know who you are. Thank you. Our numbers continue to climb into the high tens. So super stoked to have all of you checking things out and listening. And we can definitely beef on some stuff as the show goes on as well. But let's get into talking about the debt and how you used debt or how you use debt to grow, right? Using debt and inventory financing as a tool for smart, scalable growth. So I'm just going to start off by asking, why did Hollow choose to use debt when you guys started this?
Yeah. So the story of Hollow is basically we kicked off the brand actually 6 years ago. It started as a slightly different name. It's called Follow Hollow. I don't talk about this part very frequently, but I'll kind of tell the whole story now. Started as a brand called Follow Hollow. My co-founder Brian is an inventor through and through. He's an entrepreneur, but an inventor at the end of the day. And he had this idea to do these socks. And so it kicked off as an actual Kickstarter. I think we did a few 100,000 in revenue. I can't remember exactly, or like 150. I can't remember what it was, but we started with that, and that kind of is really where like there was a little bit of product market fit originally, and then he was in charge of kind of running the brand for the first year. And then a few years into Homestead, I made the decision to say, hey, I actually really want to put a ton of attention on the brand side versus just being on the agency side. That's when I took over, and that's when I rebranded it to just Hollow. I kind of got rid of some of like the coloring of the product and just like really simplified it down to just being a few SKUs and just black and gray. And in that first year, between Brian and I think we put in like 50 grand to buy inventory. And on that 50 grand of inventory, that was about $300,000 of product retail price. And that first, this was like a 3-month period of time. We went to market. I've talked about this a million times. We tried a bunch of different cohorts. We found this like hunting angle and these static ads, and it ripped. And we sold all $300,000 worth of product in like 90 days. Went 0 to 100K in revenue in the first 30 days. From there, it was kind of up to us to say, okay, we did $300,000 in revenue in a short period of time. We sold everything. We were profitable during that period of time. And it was like, okay, we put in 50 and we got back out like 110 or something like that. Or 120. Like, okay, how many socks can we buy for 120 grand now? And that was really it. That was like all that we really knew what to do, is just like, okay, put all the money back in. Let's go buy some more socks. And that 120 grand got us enough socks to kind of push into that next year and push through summer. And it was about like midsummer where we decided to say, okay, like this is working. We think this can work, but we need to put in a little more cash. And that's when I think we injected a little bit more cash into the business, maybe like 50 to 100 grand between Brian and I. So now we're at like, I don't know, $250,000 invested in. And with that $250,000, we were able to buy enough stocks to do just over $1 million worth of revenue at this point. And that's exactly what we did. We did $1 million in that first year. It was like 1.1 million. We sold every sock that we basically had. I think we were down to literally like 10 units left. And that was true product market fit. We were like, okay, we did $1 million in our first like official 12 months with this business, even though technically there were like previous years, but like with Hollow, the brand. And we want to push up. And now it's like, okay, we need more money. We need to figure something out, right? So debt was really the only option that we had unless we wanted to go the equity route. And Brian and I were both pretty convinced that this thing could be much bigger than where it was with just $1 million business. We didn't really know how to value it at that point. We were like, is it worth $1 million? Is it worth $10 million? Like, how do we value this? We weren't sure. So debt was our only option. And that's kind of what started this whole trajectory of like, we want to grow this business. We need to buy more socks. We can go equity, we can go debt. And we wanted to stick with keeping owning it. And so we went debt. And that's kind of what teed up all of this.
Was it purely based on like, I literally just need to have more in stock because I can only buy X amount right now. That's going to last me 2 months at our current growth rate. So like I could do that and I could do this way slower, or I could get debt because I know my whatever the financial term is, cash on cash return, something like that, return on invested capital or another
Yep.
would be paying off faster.
Yeah, I mean, I think the honest part of this is like I was running Homestead still during this time, and we were working with brands like Hexclad. And like, Hexclad grew, I think that same year that we did our first million, Hexclad grew by like 50 million, 100 million. I don't remember. It was the first year they grew by 50, and then the next one they grew by 100. So I'm like pushing buttons and ad accounts, working with our team, seeing brands grow 100 million, and we grew a million. I'm like, okay, I know I can do this shit. Like, I think I have the playbook figured out. We have a little bit of track record. But I wasn't sitting on a ton of cash. Brian wasn't sitting on a ton of cash that he wanted to invest in yet because it was still a little risky because it was still new. And so we were like, okay, yeah, the return on capital wasn't enough for us to push up as fast as what I really wanted to grow at. That was really it. Was we wanted to grow faster than what we could even do on our own. And the two options that we had was go, bring in investors or go get debt.
So you have this, you're sitting at you're sitting down, you're looking at this, you're thinking about this. One thing that I think you always do really well is talk to a bunch of different people in a lot of different places and get their opinion. When did this shift, and what was it that shifted in you that like you saw debt as an investment tool? Because clearly there was this delineation that happened.
Totally. Yeah. I think it was the fact that we could put $1 into the Facebook machine and see like $3 to $4 out pretty automatically, right? Without having a ton of other resources. It was like,
because you had confidence in your marketing abilities.
Correct. Yeah. And I think that the debt as a tool became just, it was new knowledge to me, to be honest. It's not like I had all this like pre-existing knowledge. I was running an agency before that. It's basically just cash flow business, right? I had no knowledge of the debt side of it. But what I did know is that we had clients like Hexclad that would get debt, right? They were working with JP Morgan at the time, and they were using debt to grow their business because they had a proven model that basically backed out to say, if I put $1 in, I can get $3 to $4 or $5 out. And we're just going to do that over and over again. And we can pay this money back to this bank. So, yeah, I think it was confidence that came from a lot of the work that we were doing for our clients at the time, and me having confidence that we actually cracked a funnel for this brand that I think could be much bigger.
So you go through this, you have this mindset shift, you're talking to them, okay, now we're going to do debt. You're talking to potential lenders and whatever. It's like, how do you convince lenders that I mean, you're a young business. Like this is obviously really
million in revenue, right? So
like how do you convince them that you're like worth lending to? This episode is brought to you by Brad's company, Work Marketing. If you need a D2C marketing agency, let me tell you, Homestead is great, but Work Marketing is also fantastic. And let me tell you, you aren't going to find friendlier people out there in the e-commerce space. So we decided to do these little ads for each other's companies. So hopefully you find it interesting. But seriously, great team at Work Marketing, very smart. Brad and Jordan are incredibly dialed in. I just gave them a lead, already made this brand that I gave them like, I don't even know, double the revenue that they had the previous month or something. So, it's very exciting to be connected with Brad. And if you need a great agency, there's really no one better. Zach,
if you want an agency that cares about your business much more than they care about their own website, I just tried to load workmarketing.com and it was broken. So they're definitely going to give more of a shit about your business than their own. So I highly recommend Brad and the team over at Work. They've been incredible. We've referred a lot of business over to them as well. Really, really good as far as like cracking funnels and figuring out like rapid growth for brands. So highly recommend these guys.
How do you convince lenders that I mean, you're a young business. Like this is obviously really
million in revenue, right? So
like how do you convince them that you're like worth lending to?
Totally. So this is where I do have to say, like, I have to give the disclaimer of I had Homestead, right? So we had this track record of helping brands grow for years already at this point. We took a couple clients from we had one case study. We took a brand from $50K a month to $2 million a month in like 90 days, right? And so we had some of these, and then some of the bigger ones, like Hexclad at this point was a client. And so when I'm talking to these like lenders, I'm also sharing those stories, right? I'm saying, hey, we're pushing buttons for these other businesses, and we've seen what it takes to grow and grow profitably. So I have that experience, but now we're going to obviously try to apply it to this one. But yeah, I mean, in the start of in 2023, we had ambitions to keep pushing, hitting the gas. I'm like, I want to grow by like 10x. Because that was just a ridiculous ambitious goal. I'm like, we did 1 million. Why can't we do 10? And that's when we started to have these conversations, right? So, I mean, I talked to everybody under the sun at that point. Like, if you go scroll back to 2023, you'll see me tweeting about like, who should I talk to? What about Settle? What about Wayflyer? What about Clearco, who no longer exists? What about normal like banks. What are line of credits? Can I use them? How does all this stuff works? I mean, I really didn't have the background outside of knowing that I needed to prove to these lenders that I had a model that was proven and that they could trust me with that model.
Sure.
Yeah, I mean, really, it started by me just having a ton of these conversations, and the one lender that really stood out to us was Wayflyer. They were the one that kind of came to us, and I met with a lot of their leadership team. I have to give a shout out to like Patty Cullen over at Wayflyer. I mean, the dude basically like came to us and said, "This is what you need to give me to prove to me that like, we should fund you." And a lot of that was just modeling. It was modeling cash flow. It was modeling profits. It was modeling revenue. It was modeling the whole financial ecosystem.
By doing that exercise, that also helped you be more intimately involved in like understanding your own financing with the business or like and
100%.
revenue growth and everything, right?
A
Yeah,
hundred
because you had to
percent.
prove
I
to
mean,
them
like,
like this is why we're worth it. This is what
right,
this
right,
is what we can do. Yeah.
totally. And as like an agency founder owner, I was good at sales always, but like it's different when you're convincing someone to give you, hundreds of thousands of dollars or millions of dollars at some point, money to like hopefully pay them back and pay them back the interest, right? So I needed to know how those financial tools worked, right? So learning how to read a P&L properly, learning what a balance sheet was different than a P&L, learning how to build like a 13-week cash flow statement and a year cash flow statement, and just knowing how all of those moving pieces worked. Was the most important part of it. Even though we were $1 million business, we had models built that were as robust as a 30, 40, $50 million business because they were so in the detail and I was so in the day to day of knowing dollars in, dollars out that was happening. It was that's what was absolutely required of them to be so confident to say, sure, we'll give you some money and see what happens.
When you're a business at like the $1 million size, like you're talking about how robust these models are, like how did you even get to that point? Like how did you make them that strong? Because at $1 million, like volatility is an insane thing. Your ad account could get shut down tomorrow and your model is completely broken, especially at that size. So like how did you even get to the point of knowing what you needed from a financial models perspective?
I ended up hiring a couple fractional CFOs in the early days and spending like a decent amount of money on that. And then we brought in an early young like finance employee, Jacob, who has been a godsend to us and just an absolute killer. But he came in the fall of 23, right as we were really trying to get, put these models together. And he helped me do a lot of this stuff, to be honest. He had a background in banking. He kind of understood a lot of these things. I understood the D2C model, but he understood like the financial model. So between the two of us and then hiring these kind of fractional CFOs, we were able to build something that was definitely more robust than what a brand at only $1 million in revenue had done. And I kind of knew that I needed to impress them to the point that I knew exactly what I was doing, which is why I was asking for more money maybe than a brand should at only $1 million in revenue.
So you get this set up, you're you got the funding, you see how it allows you to scale, you're utilizing it properly. I mean, obviously one of the things with Wayflyer is they get you the funding quickly, which is like a huge value prop, right? Speed is a big part of it. We'll talk about that. But so now it's like you're forecasting for 2024 and you go to them and you say,
totally,
we're going to grow. How do you, there's a story in here about yarn buying.
Yeah. Totally. So, I mean, the biggest thing about 2023 for us was we forecasted $9 million in revenue and we hit it on the head. Like hit it on the head. Like we did $9 million and $10,000 in revenue that year. Month over month, like was pretty consistent. We built out this model of how much we could grow and how much we could spend and how we would use that money. I think that's like the most important thing is making sure that when you're working with getting debt is knowing exactly what you're going to use those dollars for. And for us, we didn't need it for ad spend. We didn't need it for marketing dollars or team. At this point, there was only 3 people on the team. Like we were very, very small. It was me and 2 other people. And so yeah, I mean, it was mostly about saying, hey, we're going to go do $9 million. And we went and did it. And that alone, I think, is like building that trust with a lender is everything, right? If you do what you say you're going to do, they're going to be more willing to give you more money in the future. One of my mentors, his name is Rick. He's always told me this statement. He's like, you're going to want money from banks to a certain degree where then the thing switches where banks are going to want to give you money when you don't even need it, right? So I didn't say that perfectly, but basically the phrase is like, you need to try to convince them to a point until your business is big enough and strong enough and profitable and you've proven that the amount, and then they're going to want to give you too much money that you don't even need to utilize anymore. In the early days, it's the complete opposite. It's you got to pitch them and you got to prove to it. You got to build that trust. So yeah, I mean, I think the big thing for us is like the way that Hollow works is we buy our raw materials ourselves. We import our raw materials of this alpaca yarn directly from Peru. In the cash conversion cycle on that dollar spent is horrible. We buy our yarn 6 months before we can sell it. So we need money for raw materials before we can even manufacture the product, before we can even turn it into stocks, before we can get it at a warehouse, before we can even list it for sale. And that was the main use of this money. And we were very clear about like how much money we needed to buy in yarn so we could make socks in the US and so we could sell them in Q4, right? And so we proved that out. I mean, that was our 2023 goal and we did it exactly. And then going back to them in 24 and saying, hey, we want to do 20 million now. We want it a little over double. We kind of knew what we needed to show them, right? We know we needed to show them these robust models about demand forecasting for yarn buying. Here's exactly how we're going to buy it. Here's the terms that we've negotiated and gotten better with our yarn buying. Here's how we've negotiated terms with our manufacturer and how we've got a little bit more cash flow there and how that's going to help us be able to pay you back faster. Hey, we've gotten better credit card lending options and better payment terms with them, which means we're going to have more free cash flow to pay you back faster. All these things were basically the story to tell the lender how we were going to pay them back and how they could trust us even more with more money. So yeah, I mean, Wayflyer basically came to the table as one of the better options. And because they, like you said, are fast and, you know, when you're in a high growth business, you need money yesterday. We were able to get deals done quickly and get funded. So yeah, I mean, that's really what I have to say there. That got us to like that next stage. But yeah, we had our and again, one more person I just like have to give a shout out to is like Brian McDermott. He became like our new account manager, and him and Jacob were just like battling it out, making sure that all of our stuff was fully robust and so that they felt comfortable funding us. But they came through again. And without that debt, we definitely wouldn't have been able to, as a bootstrap business, go from 1 to 9 to 20.
I mean, and I think a lot of times, you know, with Wayflyer or with anybody else, it's like you guys, there's a lesson in the fact the way that you utilized and got creative with them and structured repayment, you know, terms and caps. And like, can you talk about that a little bit in terms of just, you know, you said this is what we can do, or were they more like,
yeah, I mean,
we looked at your numbers. We know this is what you can do.
Yeah, I mean, it was a little bit of both, right? I mean, they're obviously always going to optimize for what's best for them, but because we started to really understand our financials so well and our cash flow so well, we came back to them and said, hey, you know, this is what you proposed to us, but we're going to come back to you and we want flat fees. This is how we're going to pay you back as flat numbers, and we're going to structure it in like a monthly payback. It's going to get you the same number that you want at the end of the day, and it's going to work for both of us. And that they were definitely flexible there and willing to work with us. And I think that's truly why we ended up working with them and continue to work with them. Is some of these other, you know, lenders are very, very strict. They're like, here's the payback schedule. Here's how it works. You pay us back every week. It's a percentage of revenue. We rip it straight out of Shopify. Like, you know, everyone is a little bit different, but they were always willing to try to find like the sweet spot because we had proven now to them, you know, now almost at 2 years of our relationship with them, what worked best for us and how we could pay them back.
So how did you kind of are aligning, talking about, okay, here's the inventory and the revenue cycles that we have. How is it a lump sum they're giving you? Is it money that's coming in regularly? Like, how are you working all of this together with them? Or is it like an agreement for a long period of time? Or how does that work?
Yeah, I mean, the technical term I think that we had with Wayflyer that year was like a letter of intent, which is tied to like a line of credit essentially set up. So we had so many funds accessible planned for the year. And based on our models, we knew when we needed to draw down on that, and they were going to keep those funds ready for us. So it's not like we took it all in one shot. It's definitely like strategic, so that for their own sanity, you know, it's not like we were taking, you know, a bunch of money down all at once and hopefully we'd pay them back. It was all kind of based around the cash flow needs of the business. So I do think that was beneficial too. I think that also made us more cautious with the dollars as well. Like it made us more strategic with how we were going to spend every dollar that we borrowed for them. And yeah, I mean, I think that's how we ended up working it out, was like it would kind of come in tranches as needed, but a predetermined amount that they would be able to fund us over the course of a year. I mean, the biggest takeaways, I guess, of working with that and working with like, you know, Wayflyer specifically is just, you know, starting with just transparency and like being very honest of like where you're at with your brand. I think over promising, over committing, making shit up like is never going to get you the long-term results that you want. Yeah. And you're also going to end up having this like financial stress, which like if there's ever been any stress on my life, financial stress is like the worst stress. You know, product problems, things get lost at sea, whatever. Facebook ads go to shit during a week. Like those are all okay. Financial stress is like the biggest stressor. So I think just starting with transparency, sending them everything that they ask for, I think is like the most straightforward piece, is just like not being afraid to be like, hey, here's my business. Here's how I'm thinking about it. making sure that their underwriters have like truly everything that they need to feel like they can fund you. And then just like letting them know your goals and like how you're going to back into it. I think the biggest two things that they look for is like, what is your ability to pay back funds, and like how are you going to pay them back truly based on like a financial model, and two, why do you need it? I think a lot of people think, I need money to grow. Well, what is that going to be used for? Is that going to be used for 3PL fees, or is that going to be used for buying actual product that's going to let you grow the business and increase returning customer rate, which is more profitable for you than just continuing to sell the same thing? So I think being strategic about like what you're using that money for and having that very clearly laid out for them is huge. But yeah, I mean, I think that's like the first one. I mean, the models is everything else. Like having financial models that actually make sense, that tell the story of how you're going to use those dollars, from a 12-month P&L to an inventory forecast to, inventory forecast that backs into your purchasing scheduling, like giving them truly your full roadmap of here's how I run the business, here's how I make financial decisions, here's how I'm going to do it, plus then like a 12-month cash flow forecast. To them, then they have everything, in their hands to make a decision and say, should I fund them or not? Because you're giving them all of your decision making 12 months in advance. And again, you can be wrong. Like there's degrees where they'll work with you and try to find flexibility. But the more thought through you can do this, and the more you can actually use like previous data or previous history to try and show them how you've made those decisions, that's like everything. And then, I mean, the last bit, and this is more a tip for funding with really anybody, but specifically like what we found with Wayflyers, like get that funding locked in that next round before you need it. When things are good, get them the statements, get them the documents, get them everything, and tell them where you're headed and where you want to go. Obviously, there can be downturns, like there can be hard moments in a business. So having all that prepared so that you can have the money ready to rock when you need it is just super important. And that's where, people on my team have done a really good job, and I have to give them kudos too, because they've played proactively versus reactively when we need debt. So that's really
What do you think? I mean, I think all that stuff's super helpful. I appreciate you going through the tips and everything. I feel like, to be transparent, debt is one of the main reasons why, it's a main driver of bankruptcy within
Totally.
D2C
Yeah.
brands, right?
Yeah. Yeah.
It's expensive, can be, expensive. Like who shouldn't take it? Where does it not make sense? I mean, I think you've laid it out to the point of like, if somebody's really clear with what they're trying to do, they're really clear with how they're going to use it, that makes sense. But I think if maybe it's just the opposite. There's not a clear vision. They don't have good financials. They don't have a proven track record. Where are situations where you've seen debt be taken on and that's not the right call?
I think
Other
when they're
than the
using
examples
it,
I just shared.
yeah, I mean, I think it's the inverse of kind of what I said, right? So we can just start with that, right? So when you don't have those things, I wouldn't be comfortable doing it, right? Like if I didn't feel like I had all the tools ready to present to them, I wouldn't have even felt comfortable of like having money. Like, what would I do with it if I don't know what I'm exactly going to do with it, when I'm going to spend it, where it's going to go, knowing that I owe it back to somebody? Just inherently, that is like a pressure that you hold, or at least I do internally. Having that whole plan is like the most important piece. So if you don't have that, probably shouldn't take on debt. The other area that we've seen brands, like sadly through some clients through Homestead or just other brands just in the ecosystem, even some of the brands that we bought in the portfolio historically, I mean, they took on debt to run Facebook ads, things like that. It's like you're taking on money you're going to pay, 10 to 20% APR interest on it, and you're going to try and turn a dollar into more dollars, but you're not doing really the math on how much return you need to make off of the dollar you're investing into something that isn't guaranteed, right? The guaranteed thing about us is if we buy yarn to make socks, we're getting yarn, right? Like I know I'm getting yarn and I'm getting what I'm paying for. If I go use it for something that has a higher risk potential, I don't know that I'm going to get back what I planned. So to me, that's where I think using debt for things like inventory is a great use. It's an asset. At least you can, it can be turned into something. Using it for like kind of inventory that are like risky. So like maybe new products, I would be cautious to use it for. And like taking big swings, like, hey, our business isn't working really well. Maybe if we go take this big swing with this influencer or partner or new product launch, probably wouldn't use debt to go do that. I would definitely try to self-fund that because it could go to zero, right? So I think it's using it for things that don't have the risk in itself is usually when debt is more appropriately useful. It is a risk through and through. That is the point of it.
True. Yeah.
And that's why they charge interest, right? Like that's part of the business is they take on the risk of you and you take on the risk of having to pay someone back. So, but that's how I think about it.
Yeah. It's very cool. It's clearly a relationship. It's something that has allowed you to scale. I know there's plenty of other examples of mutual friends too that Wayflyers help scale. So utilizing this tool, utilizing debt as a tool and a strategic lever. So it's cool to go through it. I think we should transition into a new segment of the show called Financial Fuckups, where we talk about things that we've seen that are messed up in finances. One of my personal favorites is when people get a credit line from Meta. I'm always like, you're NGMI. Like, you're not going to, like, it just makes me nervous. I don't know how you guys feel, but when I see that happening and them not being able to pay via the credit card, that makes me a little nervous.
Like one of the first times I was ever exposed to a Meta credit line was when I got access to an ad account that owed Meta $1 million. And they didn't pay it, and they still haven't paid it, and there's no intention to pay it. And this was years ago. And I was like, oh, I didn't know that they would let you do that, but they let you do that, and that was crazy. So yeah, that's my contribution to the financial fuck ups. I've seen. I mean, we've had clients take Shopify capital loans, and I don't like have a strong opinion. I don't know enough about this, so that's this episode was like super interesting for me to just like sit back and listen, because I don't know what I don't know here, and I know that like maybe Shopify capital interest rates are not like the best for people, but if you need money with intent and you have plans behind it, like it can still work, I'm sure. But like, yeah, generally the reasons they took it was, okay, they're probably under some kind of pressure. They feel like they need it. Understandable in the moment. But like, to your point, it was for to pay down a credit card for marketing spend that like was never going to pay itself back, or was going to take years to pay itself back.
Taking on debt, it's just like anything else, right? When you're doing your business, that if it's a short-term fix and there's not a plan of how that will be avoided, then it's a Band-Aid, and that's going to be something that you're going to lean on, and it's not a good thing. It's like you need a plan for how you aren't going to necessarily need the short-term stuff. If you're talking about what Zach's talking about with Wayflyer, right? It's a long-term relationship. They know his business intimately. He's repaying. It's a good thing. They're unlocking growth that he wouldn't have, which is awesome. But there's all these,
Totally.
but when you have like a Shopify capital loan, it's like that I think is okay, but you have to have a plan in like with these small little things of how you're going to actually not be dependent on it, and how you're going to build a business to the point of real growth. Because otherwise, that kind of stuff, if you're not smart about it, obviously it can, the interest can kill you. It can double and triple down on you. And then next thing you know, you're taking out credit lines from Meta. It's like, it's bad. And the reality is too, all this goes back to what you guys have talked about on this podcast a bunch, which is you have to know your numbers. You have to know the cost of landed product, the pick pack fees. Like, it has to all be part of this equation, because we've all seen it running agencies. Like, people walk into a corner and then they don't know, and they're looking only at Meta ROAS, and you're like, there's more to the story here. And, next thing you know, they're like not making anything, and it's because they haven't known the full picture of the business.
Yeah. Only contribution to financial fuck ups is recently heard of a brand that has gotten pretty big that was postponing state sales tax, and just got hit with a ringer there. So make sure you're looking into that, because that can be one that can definitely bite you in the ass if you're
Turns out not paying your taxes is rough. And that's going to be a really difficult future for you. And the state and the federal government will find you.
Yes. But yeah, no, I mean, there's a million stories, right? I mean, there's a lot of these, and it's sad. It's a bummer that a lot of these brands go through this, get to the point where they run into too much debt, and the debt payments alone monthly, they just can't cover. And so things go under, right? But I think the best bet there is just having the plan, really understanding your numbers, having the plan, knowing what you're going to use the money for, and following through with what you say you're going to do. And if you can do those things, and it might require working your ass off and putting a bunch of hours in to make sure things go to plan, if you can do that, and that can compound year over year, it can really give you the extra fuel that you need to really push growth. And we at Hollow would not be hitting the numbers that we're hitting and the volume that we're hitting as quickly as we were being a bootstrap company and not taking any equity rounds without debt. So it's been incredibly useful for us.
Well, Zach, thanks for sharing the story. And if people have questions about it, they can email me, andrew@foxwelldigital.com. I'm happy to get you over to Zach and get connected, or hit the guys up on Twitter and we can get you connected with the Wayflyer team. That's not a problem. Before we go, it's important to say that Wayflyer is sponsoring this episode, of course. However, we only work with the sponsors that we truly trust and know. And so that's why we've chosen to work with them on this, because we think it's an important thing to unlock. And, we have bills to pay. Okay. So back off. So thank you for listening, and we appreciate all of you. And we'll look forward to the next episode.
Thanks, everyone.
See ya.
The only way that we grow this podcast is by you sharing it with your friends. Honestly, like reviews kind of don't really mean anything too much anymore. They're really meaningful, but they don't do a lot for the growth of the podcast. And so sharing YouTube links, sharing Spotify links, sharing Apple, whatever we call it under the podcast app now, anything you can share, the better we're going to be. Guys, anything else you want to say on this?
Yeah, please go check us out on YouTube. Rack up those views for us. We'd love to see it. And then subscribe. Make sure to subscribe on YouTube as well.
And I relentlessly refresh the YouTube comments because it dictates my mental health for the day. So please say something nice about all of us.
Thank you, everyone.
Thanks,
Thank
everybody.
you for listening, honestly.